If you've been keeping an eye on Canadian real estate investment trusts REITs, you know the sector has been through a storm in recent years. Rising interest rates, consumer shifts in retail, and uncertainty in commercial real estate have left investors cautious. But every now and then, an upgrade from a major bank changes the conversation, and that's exactly what just happened with SmartCentres Real Estate Investment Trust SRU.UN. The Royal Bank of Canada RBC just lifted its price target for SmartCentres from $28.0 to $29.0, issuing an outperform rating. Scotiabank and National Bankshares also nudged their targets higher, though they remain more cautious with sector perform ratings. The upgrade points to a potential 9% upside from recent levels, sparking fresh interest among investors who may have overlooked this REIT in favor of flashier sectors. So why the optimism? And does SmartCentres really have what it takes to outperform in a tricky market? Let's break it down. Who is SmartCentres REIT? For those unfamiliar, SmartCentres is one of Canada's largest real estate investment trusts, best known for its retail-focused properties anchored by Walmart supercenters. With over 34 million square feet of leasable space across Canada, SmartCentres has a strong presence in suburban shopping centers, plazas, and mixed-use developments. In recent years, the REIT has also diversified into residential and mixed-use projects, including condo towers, townhouses, and retirement residences, under its Smart Living platform. This strategy is designed to reduce its dependence on retail tenants and capture growth in Canada's housing-hungry market. Why RBC upgraded SmartCentres? 1. Resilient cash flow. Despite headwinds in retail real estate, SmartCentres has maintained high occupancy rates and steady rental income. Walmart, its anchor tenant, provides stability that many other retail REITs lack. RBC analysts see this as a safety net that keeps the trust attractive even in uncertain times. 2. Mixed-use growth potential. SmartCentres' pivot into residential and mixed-use projects is beginning to bear fruit, with demand for housing at historic highs across Canada. These developments offer long-term revenue streams beyond traditional retail rents. RBC views this diversification as a positive signal for growth. 3. Attractive valuation. At recent trading levels, SmartCentres was seen as undervalued compared to peers. The move from $28.0 to $29.0 reflects not just fundamental stability but also investor appetite for steady income-producing assets. A 9% upside is significant for a REIT in today's environment. 4. Improving investor sentiment. With interest rates expected to stabilize and possibly decline in the coming quarters, REITs are regaining investor attention. Lower borrowing costs make real estate financing easier. While dividend yields look more appealing relative to bonds, RBC's upgrade signals renewed confidence in the sector's rebound, the broader analyst consensus. While RBC is bullish with its outperform rating, it's worth noting that Scotiabank and National Bankshares remain cautious. Their sector perform ratings suggest they believe SmartCentres will do well, but not necessarily outpace its REIT peers. Why the hesitation? Some analysts remain wary of retail exposure, particularly in a world where e-commerce continues to grow, even though Walmart is a strong tenant. Shopping centers face long-term structural questions. Additionally, SmartCentres' expansion into residential projects requires significant capital, and execution risk is always a factor. What this means for investors. For current and prospective investors, this analyst activity provides several takeaways. Income appeal. SmartCentres offers a solid distribution yield, often around 7% to 8%, which is attractive for income-focused investors, combined with RBC's projected price upside. The total return potential looks appealing. Growth optionality. The REIT's push into housing could provide meaningful upside over time if SmartCentres successfully transitions into a mixed-use powerhouse. Today's investors may benefit from both stability and growth. Risk awareness. Retail headwinds remain real, while Walmart is strong. Smaller retail tenants are more vulnerable to shifting consumer habits. Investors should balance the dividend income with potential sector risks, timing, and market conditions. With interest rates expected to cool, REITs are entering a more favorable environment. SmartCentres could see improved investor sentiment simply from broader market dynamics, making this a potentially timely entry point, comparing SmartCentres with other REITs when measured against other Canadian REITs. SmartCentres sits in an interesting middle ground. Retail REIT peers compared to pure retail REITs, SmartCentres looks stronger due to Walmart's anchor stability. Residential REITs, pure-play residential REITs may see faster growth in rents, but they lack the diversification SmartCentres is building. Industrial REITs, logistics and industrial REITs remain hot thanks to e-commerce, but valuations are higher. SmartCentres offers relative value here. This balance of income, stability, and growth potential is what makes RBC's outperform call stand out. Looking ahead, what could drive SmartCentres higher? Several catalysts could push SmartCentres stock beyond RBC's $29.0 target. Successful rollout of residential projects as more smart living developments reach completion. Revenue diversification will strengthen. Interest rate cuts. Any significant Bank of Canada rate cuts would boost REIT valuations across the board. Stronger retail recovery. If consumer spending in suburban markets rebounds, retail rents could surprise on the upside. Institutional buying. Upgrades like RBC's often attract institutional investors who may have been waiting for a signal to re-enter the REIT space. Conclusion: is SmartCentres worth a look? SmartCentres REIT may not have the glamour of tech stocks or the explosive growth of industrial REITs, but what it does have is resilience, income, and optionality. RBC's upgrade to $29.0 reflects confidence in the trust's ability to navigate retail headwinds, while building a stronger future through diversification. For conservative investors seeking income with modest upside, SmartCentres offers a compelling story. For those more cautious, it's a reminder that even in a challenging real estate market, some players are positioned to outperform. What do you think? Is SmartCentres a hidden gem in Canada's REIT space, or are the risks of retail exposure still too high? Drop your opinion in the comments, and let's get a conversation going about where SmartCentres and Canadian REITs are headed in 2025. And don't forget, if you found this breakdown useful, hit like, subscribe, and ring the notification bell for more deep dives into Canada's real estate and investing trends.